Hello and welcome back. We're talking about the various kinds of cash value life insurance policies today. The last policy that I want to talk about today is universal life, specifically indexed universal life. I mentioned that variable life insurance policies were very popular in the 1990s, primarily because the stock market was on an upward movement, primarily for the whole decade. But once things began to correct, a new kid on the block, so to speak, came into play, and that's called indexed universal life policy. Now, an indexed universal life policy is different in that the interest that is credited in this type of an account is based on the upward movement of a stock index, like the Standard & Poor's 500 stock index, where your money will grow based on the movement of that index. But when things begin to correct, and they always do, your money does not correct with it. It holds pat. Pretty interesting, huh? If you can get the upward movement of a stock index, but not have to have your money reduce in value when that market corrects, you'd probably be pretty happy, especially if you're getting anywhere from 7 to 10% rate of return. So again, this is a permanent life insurance policy with the death benefit that's permanent and will be paid out upon one's passing. But also the money grows based on that upward movement of the stock index. And this is very, very popular now, with a lot of people coming into the marketplace and wanting to take advantage of the tax advantages of life insurance policies, because this is really a no-lose situation. You take advantage of upward movement of the stock index, but you do not take a hit when that market corrects. Hello and welcome back to www.rightfinancialplan.com. And we're talking about cash value life insurance policies still, and the fact that the American consumer is becoming more educated on these products and all their valuable benefits. So let's talk about historically who've used these policies and why. Well, essentially for years, large corporations, banks, university endowment funds have used cash value life insurance policies as one of the assets on their balance sheets. They've done it for the simple fact that they're very safe. Investing in insurance companies is one of the safest investments you can make, and they got to use the policy to shield against taxation. Again, the IRS allows money to be extracted from these policies tax-free if structured properly. So if they're good enough for large banks and Fortune 500 corporations, university endowment funds, shouldn't they be good enough for you? Well, of course they should be. So if money is extracted from these policies tax-free, how is that possible? Well, essentially, when you have a cash value life insurance policy, whether it's whole life, whether it's universal life, or whether it's a variable life policy, money is essentially borrowed against the policy using what's called policy loans. Now, these loans are not typical or historical like a traditional loan where you have money that's taken and from a bank or any other credit institution, and you have to pay that back on a monthly basis. That money does not need to be paid back on a monthly basis. Essentially, what happens here is the money is borrowed, and you use that for whatever purpose you want, and essentially it's paid back at the end. Upon the passing of the principal insured of the policy, whatever amount has been extracted from that policy, that will essentially be taken off the death benefit at the time the policy pays out. So you're essentially using insurance company money to finance a variety of different projects that you may have. Pretty brilliant.